Thank you for that kind welcome, George. It's my pleasure today to welcome a man who barely needs an introduction, really. Achim Steiner is the Administrator for the United Nations Development Programme and has held that role since 2017, alongside a role as Vice Chair of the United Nations Sustainable Development Group, which unites 40 entities of the UN system that work to support sustainable development. But his heritage in seeing finance as a route both to human development and to environmental protection extends far beyond this, with his work over 3 decades in this field, including past roles at the United Nations Environment Programme across the globe and in academia at Oxford University. So for what I'm sure will be a fascinating session on going beyond climate, Achim, the floor is yours.
Thank you for your kind introduction, Kat, and thank you to the Global Ethical Finance Initiative team for the opportunity to speak to you today and to join you for this event. Excellencies, ladies and gentlemen, the 2021 Ethical Finance Summit is taking place at a critical moment. For the first time since 1990, global human development is going backwards due to the impacts of the COVID-19 pandemic, and with the poorest and most vulnerable being hit the hardest. The pandemic has also exposed deep inequalities, weak health and social security systems, and the digital divide. At the same time, our planet's precious ecosystems continue to be degraded and destroyed. With it, biodiversity is withering before our very eyes. Almost unbelievably, up to 1 million plant and animal species now face extinction, many within decades, because of our activities as human beings. And climate change continues its relentless march. The pandemic has also triggered an extremely challenging environment for development finance. As a result of COVID-19, the SDG financing gap may balloon from $2.5 trillion to $4.2 trillion. And yet, the sustainable finance challenge is not simply one of filling financing gaps. After all, reallocating just 1.1% of the total assets held by banks, institutional investors, or asset managers, some 4.2 trillion, would be sufficient to fill the gap in SDG financing. Rather, I see 2 key areas that require our immediate focus. Firstly, national financing strategies need to encompass the right policies to mobilize finance towards the SDGs. To drive forward progress in this area, the United Nations Development Programme is implementing a support program on integrated national financing frameworks today in 71 countries, in cooperation with the European Union, the International Monetary Fund, and other parts of our United Nations system. This effort is helping to contribute to the fact that financing for the COVID-19 recovery is fully aligned with the SDGs and the Paris Agreement. And UNDP is now the secretariat to the G20 Sustainable Finance Working Group, co-chaired currently by China and the United States. It is playing a key role in examining the major gaps and barriers to mobilizing sustainable finance. Secondly, the private sector has a pivotal part to play in driving finance towards the SDGs. Therefore, SDG Impact, a flagship initiative of UNDP, is engaging directly with businesses, investors, and policymakers to develop the business case for the alignment of their activities with the SDGs. The ultimate aim is to foster more inclusive and resilient economic growth. And its SDG investor maps now offer accessible local market intelligence on sustainable investment opportunities. That includes openings in vital sectors like food and agriculture and renewable energy, or look to UNDP's SDG impact standards for bond issuers, for instance. It supports the integration of the SDGs into business and investment decisions. The standards were used by the New Development Bank recently in China to issue a Sustainable Development Goals bond valued at $767 million in March of 2021. With groundbreaking initiatives like SDG Impact, our objective as UNDP is to help to mobilize historically new levels of finance towards the SDGs. Very much what this event is about, and that many of the distinguished speakers yesterday and today that you have brought together are addressing. At this global turning point, such efforts will help countries and communities to build forward better from this devastating pandemic and ensure that this does become a decade of action for the SDGs towards a greener, more inclusive, and more sustainable future. Thank you so much.
Thank you very much, Achim. There's so much to pick up on in that speech. And I suppose where I'd like to start is really at the top level. So even before the pandemic, only a few countries were on track to deliver the SDGs by 2030. And we've now seen a deepening of inequality, a weakening of health systems and social security, and increasingly links between health, ecology and climate. So can we genuinely do this? Do we start thinking about extending targets, or is there a sequence that we need to look at the SDGs in where they start to unlock progress on each other?
Well, let me begin by answering that certainly meeting the SDGs has not become easier. And I think we are experiencing setbacks right now that will literally not only take away what we have already accomplished, but in fact set us back by a number of years. But as always in our very diverse world, there are very different pathways. First of all, countries have, entered this pandemic in a very different state of national economies, but also of social protection systems and ecological policies. And I think what we certainly should not do is to be tempted by this notion that, are the SDGs, because they have become more difficult to achieve, therefore less relevant. On the contrary, I believe the SDGs are precisely the compass that we need right now in order to be able to get out of this pandemic tail end that is quite long and very brutal in some countries. And at the heart of this is really an appreciation that it's not the trade-off of one sector against another. It's not the trade-off of one population group or a region against another. It is how national economies can recover where both environmental sustainability and social equity are drivers of economic recovery. That's precisely at the core of the SDGs. And I would argue that if you look at climate change today, we are in fact in June of 2021 closer to perhaps meeting the Paris Agreement targets than we were 18 months ago before the pandemic, because things have changed. Politics has changed, public attention has changed. We have seen announcements that would have been unimaginable from some countries just a few months back. So let us not take setbacks as a reason to abandon the goals, both in their objectives, in the targets we've set ourselves. They are not just things that you can choose to ignore or not. They are rooted in reality, in international agreements, in science. What we need now is acceleration, scaling up, and also investing every dollar, every euro, every pound in a way that generates more than just a singular benefit and outcome. That is part of the SDG ingenuity also, designing investments that yield multiple benefits.
Great. And obviously you spoke there about making sure that we make the most of the funding that does go into this, but you've also mentioned that the financing gap has increased really substantially here from 2.5 to just over 4 trillion. And yet you're talking about essentially a system of values that can go on to create value. So the challenge in that is for whom that creates value, who ought to pay for them, and why that should be the case.
Well, let us first of all recognize that at this very moment, in many countries across the world, we are facing extreme fiscal space constraints. Maybe put in other words, countries are just running out of money in terms of public budgets. So the ability to first of all manage the crisis, but also to invest in stimulus packages to come out of it are severely constrained. And in fact, in a recent research paper that UNDP put out, we echo also the messages of the International Monetary Fund. The debt issue is beginning to become a severe problem, not only in terms of the immediate management of the crisis, but also in recovery terms. So we have to address underlying issues such as debt. And therefore, the debate that is currently being conducted with the G20 and in the International Monetary Fund are critical, particularly for the countries that are most vulnerable to, in fact, become unable to service their debts. And, there are countries such as Zambia today where 40% of the national budget actually goes towards paying interest and repaying loans. I mean, certainly this is not a way in which you can manage a recovery. Having said that, the world is wealthier today than it has been at any time in history. In fact, our financial markets and investors and funds are desperately looking for ways to invest money. Interest rates are at record lows. So you would expect that there is a unique opportunity, a window of opportunity also to leverage and attract significant private capital in alignment with the SDGs to invest. And here, let me use the term invest deliberately. It's not just an argument in favor of public budgets and funding, which means you have to raise taxpayers' money and revenues, and then you reinvest them, so to speak, in the economy. We're talking about genuine trillion-dollar investment economies that are emerging with the transition to low-carbon economies, but also with continents such as Africa, well over 1 billion people right now. By 2050, perhaps a 2 billion people market. these are opportunities right now that I think we need to help the world's financial system that is sitting on extraordinary wealth and is looking for ways to invest, to be able to find ways in which, through good governance policy, good regulatory frameworks, good governance, we actually create opportunities to invest in sustainable development, because ultimately that's what's going to keep the economies of the 21st century going. And that is the unique moment in time, but also the confluence that I think we all need to work towards right now.
And so obviously we are seeing markets making a really significant shift towards ESG investment generally, and in some instances also towards SDG specific investment. But most of that is still bypassing a lot of the developing world. And so if we were going to pick a couple of things that would help reallocate that 1.1% of assets towards the SDG goals, are we talking about making it clearer that you're avoiding failure costs? What are the things that will make this possible for financial institutions?
Well, as always, it takes two to tango. So there are those who are capital owners, and then there are those who are seeking to essentially attract capital. And I think much of what UNDP, as the development program of the United Nations, does is to help countries look at how they can be more attractive investment destinations. First of all, by helping them to address the incentives for financial markets, and beginning with domestic financial markets, in fact, to invest in opportunities that have to do with access to electricity, educational services, health services, but also infrastructure related to mobility, agricultural productivity. I mean, these are all sectors that, you know, are not beyond the purview of a private sector investment logic. On the contrary, much of our global economy, in fact, is based on private sector investment and business. The challenge we face is that many of these countries, first of all, are small. They are not as attractive on the international highway of investors in order to focus on them as particular cases. And I think what we're doing right now, for instance, with SDG Impact and the investor maps, is precisely to bring public policymakers and private investors together to recognize an opportunity. Let me give you a very simple but powerful example: food waste. More than a third of everything we produce on our planet every year in terms of food is never consumed. It's either lost between farm and market, or it is just thrown away. This is an extraordinary, not only macroeconomic waste, but an environmental disaster, and in a world where, you know, hundreds of millions of people don't have enough to eat. Now, in a major economy like Brazil, we have seen that a lot of that loss of food actually has to do with lack of storage and lack of connectivity of producers to markets. Both of these, i.e. the transport sector and essentially the real estate sector, building storage, grain silos, are eminently private sector investable in. So getting government to put the right incentives in place and then mobilizing significant amounts of private capital to expand the storage capacity of the Brazilian economy, and to get the transport sector to add the last 5% of the capillary structure of transport, connecting producers to markets, could significantly cut one of the world's major food producers' losses in food waste. And this is the kind of public policy, incentives and regulatory analysis that is needed, and then the private sector to step up and actually seize the opportunity. And so this is part of the work that we are trying to do in many of these smaller, least developed countries, low-income countries, that on their own will struggle to attract the interest and the attention of international financial markets. And at the end of the day, it's a form of de-risking through smart, transparent public policy, but also of incentivizing and engaging with private sector investors, because many of them, in part, have never invested a minute in understanding what might be the opportunities of these countries. And I think in a world that is increasingly riven by inequality, this is not just something within our own societies. We have a world right now, not least with the digital economy emerging, that could be on two very different tracks. And if the majority of the world's population is not part of the world's financial system in the sense of an investor, then we are in trouble.
So if the SDG impact work is sort of helping to make the business case for investment by really exploring local viability issues, local market viability issues, what does ambition look like here? Who is using the SDGs really well as a brand to drive investment? And what does saturation look like? So how do we get beyond the big companies that are going to do it themselves and right down to as you say, smaller countries and down to SMEs? Well,
you know, it may seem a little bit surprising, but to me, in the 5 years since the SDGs were adopted in the General Assembly in 2015, perhaps the most surprising sector that began to really engage with the SDGs was the financial sector. If you go to the World Economic Forum in Davos, for example, in January every year, although this year it obviously didn't happen, one of the striking things last year, the year before, was that all over Davos you saw the Sustainable Development Goals logo. The financial sector, banks, funds were in fact looking at the SDGs as a way of globally de-risking the economy. Because if you can address issues such as poverty, unemployment, discrimination, but also environmental hazards, climate change risks, you are de facto creating a more stable investment economy. So just to pick an unusual example, the finance sector was one of them. And then there are countries that obviously at very different levels are leveraging the SDGs. I mean, we worked, for example, with Mexico last year when it issued a bond on the European financial markets, an SDG bond, the first ever, and invited UNDP to provide, in addition to its own transparent prioritization of SDG-related investment priorities, the United Nations Development Programme as a partner in order to validate also the SDG approach. We saw recently, and this is part of the work that SDG Impact has done by developing these standards for the issuing of bonds. We saw the new development bank actually launching an SDG bond, again about $800, $900 million, that fully applied these norms that we have developed. And part of what we're doing here is to give governments also a degree of self-discipline, transparency, and a template with which to approach the financial markets and say, we are borrowing in order to invest in the development of our country according to SDG parameters. And in both cases, they were oversubscribed. So I see enormous potential, as we all do, in that broader sense of impact-oriented investments, because both financial institutions have enormous demand that they're getting from their clients in order to invest in areas that actually, help solve problems as opposed to amplify them. And secondly, governments have recognized that this is a way in which they can capitalize also investment programs in their countries in ways that yield multiple benefits. And we often talk about climate change. It's one entry point into an investment proposition. You could also say access to clean energy. In Africa, 600 million people have no access to electricity today. So the same investment could be rated as a climate change investment from one perspective. On the other side, it is what African countries need right now, which is capital to invest in electricity generating infrastructure. And suddenly we have a unique opportunity to co-invest here. Clean renewables on the one hand, providing hundreds of millions of people with access to electricity, vital driver of development. On the other hand, getting a continent like Africa to embark and invest in a energy matrix that is fundamentally different from that of Europe's last century. 2 billion people emulating Europe in this day and age would be the end of the Paris Agreement. And quite frankly, we really would surrender to climate change as a given.
So you mentioned sort of the role of essentially how we develop the global south and all of this. And you've mentioned also China's development bank issuing SDG-led bonds. We have a number of other development banks taking part in this summit, and obviously Scotland has just launched its own one in the Scottish National Investment Bank. So what role do you think development banks need to play in supporting countries move towards the SDGs?
I think national development banks have an extraordinarily important role to play. Depending on which part of the world and which country you look, sometimes they're very much in the front line of also, trying to help realize the role that they can play in influencing financial markets and public investment portfolios. Last year in Paris, we had a summit of over 100 national development banks from around the world. And I think it was an eye-opener to many that, in fact, these are institutions that are embedded in not only national economies, but also able to operate in domestic and international financial markets, are part of national development policy and priorities that are, essentially decided by countries on where to invest. Getting national development banks to become key players, both in influencing national financing, but also in leveraging private sector capital into an investment pathway for a country, I think is enormously important. And so for UNDP, this is a group of institutions with which we work, and certainly Scotland's mission-led development bank has been a great example and inspiration, not just to us, but I think to a number of national development banks that are rethinking their role in not only times of a pandemic, but indeed of the Sustainable Development Goals challenge.
That's great. Thank you very much, Achim, for your time and for your provocation of our thoughts.
It's a pleasure to join you. Thank you so much, Kat.